And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's Monday as we get ready to wrap up the month and a big bulk of earnings season. We'll get wrapped up over the course of this week. We'll get into that this morning a little bit more. Again, kind of the big news this morning is that over the weekend, the EU and the United States reached a trade agreement, so to speak, and of course we haven't seen the final details of it, but that kind of resolves one of the big outstanding issues with tariffs, and of course this August 1st deadline for tariffs, which was going to raise the tariff rate. Puts a 15% tax on tariffs for the EU, keeps a 50% tax on autos, and we'll see what happens here ultimately, but it's supposed to also provide, and this is an undisclosed amount, but a massive purchase of U.S. military equipment. Again, a lot of these things, when countries go, oh yeah, we're going to buy 500 billion of that, or we're going to do 600 billion of this, that, or the other thing. Those things rarely come to fruition. It sounds great, but there's no real hammer for making sure those purchases actually occur. So, these are like, oh yeah, you want us to purchase $500 billion worth of goods? Sure, we'll do that. But the reality is a lot of those things don't really happen. But the news is that a deal has been reached. So at least we're starting to finalize some of these more important trade agreements like China, like Japan, like EU. China's still out there a bit, still negotiating with them. But kind of getting these more major trading partners in place. Again, there's a lot of countries that we don't do a lot of trade with, so deals with them aren't nearly as important. But the EU, which is comprised of, of course, Germany and France and Switzerland and these other countries that all make up the EU, it's about 17 countries. That's kind of a big chunk of the work right there. So anyway, good news over the weekend. So we'll see how that plays in the markets today. Of course, the big news this week is going to be earnings. We have Google, Amazon, Meta, and Microsoft all this week. I think I said that right. Apple, Meta, Amazon, and this week, and Microsoft this week. So big four of the big seven are all this week. Of course, all eyes are really going to focus on these companies more than anything else because they are heavily involved in the artificial intelligence space. So kind of the key things to watch out for in these earnings reports, they're going to beat earnings, right? They're going to beat estimates. Those estimates have been lowered dramatically, so they're going to beat those. I'm not worried about earnings and revenue. What is going to be key for these companies is A, their outlook, and B, what do they say about CapEx spending for AI? That's going to be it. Right. So any big reduction, that's going to be a negative for those companies if they come out and negative kind of for the AI space in general. Don't really expect that to happen, but that's going to be really the thing, is if there's a disappointment in the outlook, that's going to be the big driver for the markets this week more than anything else. But also this week, having said, besides earnings, we've got PCE this week as well. That's the kind of the key measure that the Fed looks at in terms of monetary policy. We also have a Fed policy meeting this week. So it's going to be a very busy week in terms of data, which could certainly pick up some volatility in the markets. And again, that's, this is one thing we haven't seen as of late in the markets is volatility. It's been a very, very stable market. In fact, we've had a very long stretch of days where we have not had a plus or minus 1% move in the day. It's been a very low volatility advance over the course of the last several weeks. And again, nothing wrong with that, but low volatility advances tend to beget periods of higher volatility. So, and also too, when you just talk about volatility as itself, we are moving into a seasonally strong period for the volatility index. So, what we've seen so far to date really is very normal for kind of volatility to be declining here, particularly as markets are advancing as strongly as they are right now. But we're about to move into 2 months where volatility tends to pick up a bit. Again, August and September, as we've talked about, I've warned before, tend to be weaker months. And that's just at least something worth paying attention to. And that will kind of bring us right to where we want to be this morning to talk about what you need to know before the bell. markets, as I said, have had a very long stretch with very minimal movement. This has been a very quiet move higher, right? There's, the ups and downs every day are very mild. We don't have big drawdown days, the advances days, or up half a point or whatever. Very quiet advances. Now, below the surface, there's been some really strong gains. But overall for the index, it's been a very, very quiet, what we call low volatility advance here. Volatility has been declining. But two things to really kind of pay attention to. One, the market has been above the 20-day moving average now for one of the longest stretches in history, going back to 1965. Now, that doesn't mean anything. It just means that the market's been in a very bullish advance for a very long time. Typically, the market does not trade above the 20-day moving average for very long periods. That's kind of a short-term correction point. Markets, rally a bit, 10, 20, 50 days, pull back, those type of things. But when you get very, very long, and that's what this has been, is basically a 68-day advance now above the 20-day moving average, that's just very extended. At the same time now, we have money flows beginning to decline here. Again, sign of exhaustion. This market's been very bullish here for a while, advancing every day. It's been very good. Everybody's very excited. Sentiment is very bullish. Positioning is very bullish. We see a lot. We've talked about recent excesses and speculation in the markets, and that's because the market's just been grinding higher, right? It's a no-lose market. I throw money in the market, it just makes me money. So again, everybody's very excited here. So again, that's fine, but you're starting to see some signs of exhaustion. And typically when you see signs of exhaustion like this, you at least get a short-term pullback, or at least kind of a consolidation period in the market. So again, to kind of watch these periods. Last time we had a significant drawdown in kind of money flows was back going into March, and then of course, April was the Liberation Day thing, but markets were already declining prior to the tariff announcements. Then we saw a pullback here in monetary flows, in money flows back in late June. The market just kind of pulled off a little bit, was a lot, tested the 20-day moving average, took off from there. So again, that this declining of money flows doesn't mean anything other than the markets are likely getting set up for some type of a correction. And it's particularly the case when you have relative strength and momentum as elevated as they are right now. So again, there's just, as we talked about before, the risk of a correction are starting to build here. The problem that I, a little bit concerned about as always is I'm starting to hear a lot of people talking about the same thing. And of course, markets tend to do the opposite of what everybody thinks. So kind of everybody's talking about a correction and kind of August, September right now. But that doesn't mean it has to happen. The odds are building that we will have some type of a pullback in the market, just very extended, very long, very, very complacent. You're going to have a pullback. Timing's always going to be the issue. But doesn't mean it has to happen. I mean, I've seen stranger things in recent history, even where markets just stay elevated for quite some time, kind of keep that grinding higher. Eventually, they do give way. But right now, there's a lot of momentum, a lot of bullish bias here that's keeping asset prices elevated, at least for now. So again, go ahead and remain allocated to markets. But again, practice that portfolio management structure, right? Take some profits, rebalance risk as needed. Holding a little bit of extra cash here would certainly not hurt you very much, but would certainly give you an opportunity to buy some things that do pull back on a short-term basis. Outside of that, the rest of the market continues to do okay. Kind of watching the dollar. This is kind of a key for a lot of things, but the dollar's been really basing here, starting to try to turn up here as well. So if we start to get a very strong rally in the dollar, that's going to have some impacts on other assets as well. So keep a watch on the dollar here. It's very oversold, trying to form a base, and if we do start getting a stronger rally in the dollar later this summer, that could have impact on commodities and a lot of other things that are dollar related. So it's at least worth keeping a very close eye on that. That's what you need to know before the bell this morning. We'll come back, pick up, talk a little bit more about what's coming up this week, as well as kind of what's going on in the markets in general. I'm your host, Lance Roberts. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Will Social Security be there for you when you're ready to retire? Richard Rosso and Jonathan Penn host our next Candid Coffee on Savvy Social Security Planning, Saturday, August 23rd. When should you apply for Social Security? And how much should you expect to receive? Register today for Savvy Social Security Planning, Saturday, August 23rd. Candid Coffee with Rosso and Penn at realinvestmentadvice.com. Realinvestmentadvice.com.
This is Lance Roberts with some exciting news. If you've been tuning into us every morning right here on KSEV, starting August the 4th, we'll be exclusively digital on YouTube. So make sure that you like and subscribe our channel at YouTube. It's The Real Investment Show on YouTube, also streaming live on X. Just search The Real Investment Show on YouTube and hit subscribe. Starting August the 4th, we'll be exclusively digital. Get daily market insights, interviews, financial truth, anytime, anywhere. We'll see you there.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, as I was saying, over the weekend, passed this kind of U.S.-EU trade deal, and again, markets are trading, kind of positively this morning. But again, it's interesting that, the big concern for the markets was supposedly going to be tariffs, right? We had this big sell-off in April. Oh, tariffs are going to be terrible, and we were writing articles saying tariffs aren't what you think they are. And, really since then, the markets have come roaring back. Doesn't really care about what goes on with tariffs. You would think that with a tariff announcement between the EU and the U.S. that resolves that issue, that markets would be up very sharply this morning. We're up about 15 points on the S&P. I mean, it's going to be a very mild open this morning. So, the thing is markets have already priced in a lot of the reality that tariffs are not really inflationary and that they only impact a very fragmented part of the economy. So markets are trying to see that, and they're focusing on what's going on with earnings. And if you take a look at earnings announcements, the mention of tariffs and concerns about tariffs have fallen sharply. So, this is all kind of working its way through. And again, as we've talked about so many times before, these narratives that people come up with saying, oh, this is going to be the thing. Excuse me. This is going to be the thing that implodes the market or whatever it is, typically turns out not to be the case. Markets tend to adapt for things very, very quickly. As we've talked about before, they kind of see through things. And again, the one thing that matters more than anything else is whether or not that issue, whatever it is, actually impacts earnings, and particularly forward earnings expectations. And so now what we're seeing is, analysts got very negative on earnings back in March and April. Estimates came down sharply, and now they're starting to rise up again. They got overly negative on earnings. Now companies are coming in, crushing earnings. We've got about an 83% beat rate on earnings right now. As of the end of this week, we'll have about 80%-ish of all the S&P 500 companies will have reported. So we're going to have a really, really good handle by the end of this week about what the real impact of tariffs are and what that potentially means for earnings and earnings growth and the outlook for AI and those type of things. So markets are really starting to focus back on those things other than, kind of these narratives that are out there. And this is why we talk about so much, be careful with these kind of calls for, market crashes and bear markets and the end of the bull market and those type of things, because those things tend not to happen. They do occasionally happen. I mean, we had, 2008, we had 1999, we had 1974, you had 1929, but those are very, very long in between, right? That these type of things occur. And there's big catalysts behind the reasons that you have those. And we just, don't have that right now. So, we'll see what happens here over the next few weeks. But, again, markets are doing okay. And as we talked about before, it's important to stay invested when markets are traveling higher, and they are doing that right now. But we also need to be aware of the risk. And there are I'm not saying there are no risk out there, because there certainly are. And the risk that potentially gets to the market is the one thing that none of us are talking about right now. It'll be something that crops up. And we'll go, didn't see that coming, right? So that's just the way markets work. But anyway, this week, like I said, we've got quite a few things that could be market-moving events. We'll see what happens. At least could probably pick up on some volatility a bit this week. Again, we have the FOMC policy statement on Wednesday. Not much to expect from that. Pretty much, I think it's going to be a reiteration of what we got in the last meeting. Focusing on, what tariffs mean. They're still worried about tariffs showing up in inflationary pressure somewhere. We haven't seen it yet, but they're very focused on potentially that those are going to show up at some point in the future in terms of, higher rates of inflation. We'll see if they're right, but that's their big concern. So I wouldn't expect on Wednesday really anything other than just a repeat of what we saw in the last meeting. No rate cut this meeting. An outlook for, concern about inflation. Employment is fine, nothing to worry about there, so no reason to cut rates. And potentially kind of set the stage for, September, for maybe a rate cut in September. Now, the one thing that could be very interesting in terms of the Fed meeting is if they say something about QT. So quantitative tightening is the reduction of the Fed's balance sheet. They were doing $25 billion a month in terms of QT. They dropped that down to $5 billion a month back earlier this year. And so the question will be, at some point, do they take that to zero reduction to provide some liquidity to markets and, again, help start to support the Treasury market a bit as well, a bit more? And there's been some other actions. We wrote an article about the the SLR, which would potentially bring some more purchases back into the bond markets as well, particularly with interest rates a little bit elevated here. So we'll see. But, restarting QE would certainly provide, benefit for the bond market as well, because that would bring an additional buyer back into the market. So pay attention. It'll be interesting to kind of pay attention. They could, not cut rates, but they could alter the makeup of their quantitative tightening, and so that'll be something at least worth kind of paying attention to in this meeting coming up this week. This week is also the PCE reflation report. So this is the preferred inflation, the Fed's preferred inflation measure. So while we take a look at CPI, while we take a look at PPI. As measures of inflation, we go, oh my gosh, this is, hotter than it was last year, whatever. The Fed really pays attention to PCE. So this is the inflation report related to personal consumption expenditures. So when we get the personal consumption expenditures report, we also get an inflation report with that. So that'll be this week. So if that number comes in softer than expected, that's going to potentially start to undermine the Fed's position on not cutting rates. So again, we'll kind of see what that looks like. But personal consumption expenditures have been weak in general. We're starting to see kind of signs of the economy slowing down. But just as a good example, I mean, my wife and I went out to eat at a restaurant this weekend. Generally, this place is packed, and just there was nobody in there. It was pretty much empty. So Taco Bell has a line around the building. But higher end restaurants, are starting to see, I think, a little bit of a slowdown. And again, it's not surprising. I mean, you go out to eat, it's you got the bill for the food, which is getting high, and then you get a 3% surcharge for the credit card purchase, and then you get the tip that they want on top of that, and so I mean, getting ordering out is one thing, and that's getting very expensive as well. And we talked about before that 75% of restaurant orders are now delivery food. But dining in at restaurants is about 25% of the revenue, but that's also expensive as well. And again, we're starting to see a slowdown in higher end restaurants. So again, we'll see how that fades through. But that all potentially, if that's an indication that consumers are starting to contract here a bit, then that should feed through into both PCE and PCE inflation. Now, why is that important? Because PCE, the report of personal consumption expenditures, has a very high correlation to the annual rate of change in earnings. That has a very big impact on the markets. So pay attention to PCE and particularly PCE inflation, because if those show signs of slowing down, that is going to potentially impair forward earnings estimates and keep them more suppressed, which is going to make valuations more problematic. And speaking of valuations, we've had a very, very big surge in valuations just over the last 2 months. We were trading about 20 times earnings back in April. We're back up to almost 22 and a half times earnings now in just a matter of a couple of months. We've had a very big surge, and that's because earnings earnings are doing okay, but the market has advanced faster than the earnings. So we're starting to see valuations pick up pretty sharply here. And again, valuations are a terrible timing metric. What valuations are good at is telling you what investor sentiment is. And investor sentiment is getting very, very bullish right now, which, again, when you have this kind of offsides positioning in the markets, that's where the risk of a correction of some sort begins to occur. So again, we're going to get more reports on Wednesday and Thursday of this week. You got Amazon, Google, Microsoft, Apple all reporting this week. And so big reports this week coming on that front. And again, that'll all be AI related. Particularly when you take a look at some of the as I said earlier, the kind of the capital expenditure side of that, that's going to be a big test for the markets this week. But again, we have a lot of earnings this week. By the end of this week, 80% of companies will have reported. The good news about that is that also opens up the buyback window for all these companies. So we're about to see the buyback window open, corporate buybacks open back up after this week as well. So that'll help give the market some support. And again, there's a lot of people expecting a correction in August, September, me included, just because of the technical makeup of the markets right now. But it doesn't mean it has to happen. And again, you're going to get this buyer of stocks coming back into the markets as well. But that's also one thing to pay attention to in earnings reports this week, is particularly with the big boys, is increases in buyback announcements. In other words, does Apple and Meta and Microsoft come out and say, oh yeah, we're increasing our buybacks by another $50 billion or whatever it is? That'll also be important. We're already on track for record buybacks this year in the markets exceeding $1 trillion. That's a huge buyer for assets in the markets. All right, quick break. We'll come back. Continue with the show. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Will Social Security be there for you when you're ready to retire? Richard Rosso and Jonathan Penn host our next Candid Coffee on Savvy Social Security Planning, Saturday, August 23rd. When should you apply for Social Security? And how much should you expect to receive? Register today for Savvy Social Security Planning, Saturday, August 23rd. Candid Coffee with Rosso and Penn at realinvestmentadvice.com. realinvestmentadvice.com.
This is Lance Roberts with some exciting news. If you've been tuning into us every morning right here on KSEV TV starting August the 4th will be exclusively digital on YouTube. So make sure that you like and subscribe our channel at YouTube. It's The Real Investment Show on YouTube, also streaming live on X. Just search The Real Investment Show on YouTube and hit subscribe. Starting August the 4th, we'll be exclusively digital. Get daily market insights, interviews, financial truth, anytime, anywhere. We'll see you there.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
If Lance dressed up like Danny, maybe his wife would listen to him. No, that is not the case in my household. I actually had this conversation.
She wouldn't listen to him anyway.
The Real Investment Show podcast.
I had this conversation with my wife yesterday. I told her no on something she wanted to do, and she goes, "I'm sorry, I think I misunderstood what you said."
Same show, your schedule.
You meant, yes, you could do that, right? And I was like, yes, honey, that's what I meant. So, yeah. She goes, "I'm going to do what I want to do." I'm like, okay.
All right, love you. See you.
Exactly.
At realinvestmentadvice.com.
I could wear a tuxedo, and she is not going to listen to what I have to say.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Headline this morning, Netflix to reboot 1990s globalist propaganda show, kids show. Captain Planet is coming back. So, and if you're a child growing up in the 90s, that was all over the place at the time. So it's interesting. Captain Planet is infamous for being one of the dorkiest, and I'm reading this from the article. Captain Planet, infamous for being one of the dorkiest and preachiest cartoons ever made, preached to kids about the virtues of environmental panic and progressive multiculturalism. It was woke before we actually named it woke. So that's a quote from the article. So Netflix is going to bring it back. At the same time, Ulta has fallen into the Bud Light trap. Are you aware of this, Brent?
Oh, no. What's now?
So my wife went to Ulta over the weekend.
This is the makeup store,
This is
right?
the makeup store with my wife. So my wife and my daughter went. By the way, we had drama at the Roberts household. Drama over the weekend. My daughter showed up in tears. My 18-year-old, she's the youngest. She showed up in tears. Her first breakup.
Oh.
So she's been dating this boy for 2 years. They broke up. It's tragedy. And of course, how do you mend a broken heart?
You break his legs.
Well, that was my job.
Oh, okay.
My wife's job is nails and shopping.
Oh, yes.
Right.
Retail therapy.
Retail therapy. So my wife took my daughter doing shopping and retail therapy this weekend. So they went to get their nails done. Then they went over to Ulta. And my wife's been trying to, she's very pretty. Brent will tell you. He'll confirm. She's very pretty, but she's getting a little older now, right?
You wouldn't be able to tell it.
No. I'm
just saying.
She's 29 for sure.
Forever.
Forever. But anyway, she went to Ulta and was looking for some new makeup, and there was this guy there behind the counter in full makeup. And now let me just explain something about how this went. With a man who was wearing full makeup, trying to tell my wife how to do her makeup.
Is there audio?
Did you get the part where this was a man trying to tell my wife how to do makeup?
Tell me they recorded this.
They did not record this, but my daughter had the best story of it when she came home. She gave me the details. This did not go well for him or the makeup job. But anyway, so my wife went to Ulta and then came home, and she's telling me this whole story about how a man tried to tell her how to do her makeup. Did not go well. And then shortly after that, there is now a what do you call it when you when this happened with Target? People refused to go shop there. A
boycott.
A boycott. Thank
Yes.
you. I was missing the term.
A person caught.
A person. Yes, we are having a person
Yes.
caught. So there's a person caught now going on with Ulta because they did exactly what Bud Light tried to do, which was to hire Dylan Mulvaney to basically represent Ulta. And so now people are going, I'm not going to go shop at Ulta. So I don't know why these companies cannot figure out how not to do that. Just stop doing this, because it hasn't worked out. It has not worked out well for one company yet. And for some reason, we just kind of keep doing the same thing. So
did Ulta hire the chick from Michelob to do that?
Bud Light?
Bud Light?
Yeah.
Oh, really?
Yes. That's what I'm saying. They hired Dylan Mulvaney to come be their brand ambassador.
The marketing girl who thought Dylan Mulvaney was a good idea.
Oh, yeah. Well, I don't know. They must have hired, maybe the same person.
Could be
the same person. But anyway, so Ulta now has a boycott going on. A person caught, sorry.
Person caught, yes.
Person caught going on. And my wife does not have makeup.
She doesn't need it.
So
she looks good en natural.
She's going to go find makeup somewhere else. I wish I could have been there so I could have explained to this poor guy.
Yeah.
Don't try to tell my wife to do anything. I told you the story. I tried. My wife does not listen to me at all, period. I cannot imagine that went well at all. Anyway. Captain Planet coming back.
Mm-hmm. Can't wait.
Can't wait. Keep trying it till, well, they say if at first you don't succeed, try again. We'll see what happens. Anyway. Mrs. Roberts does not have big bushy eyebrows.
Oh, not at all.
I don't know why you would think that. So,
where did that come from?
From the chat, people. Anyway, all right, back to work. So we're just talking a little bit about, kind of the big events coming up this week. And again, there's nothing at this moment that is kind of overhanging the market that's a big risk. So again, as we talked about before, there's no reason to be overly bearish in the markets right now. But excesses are getting built up, and that typically tends to lead to short-term corrections. Doesn't happen, and that doesn't have to happen. As I noted, earlier in the show today, there's so many people now calling for correction that makes me nervous, right? Because typically the markets if everybody expects something to happen, that's when it tends not to happen, because markets tend to do the opposite of what everybody expects, and that's just the way markets work. And there's a lot of people right now calling for a correction sometime this summer. So again, that doesn't mean it has to happen. The odds are building up that you're going to get some type of a pullback in the next couple of months. The technicals are certainly supportive of that. The underlying dynamics are supportive of that. This complacency level is supportive of that type of a correction, but it doesn't mean it has to happen. Maybe it doesn't happen until October, November, right? You've got to get, potentially we've got to get to, this market's got to stay elevated long enough that you start, people go, oh, well, never mind. We're never going to correct again. And then you can have the correction. But again, there's a lot of conversations right now about hedging portfolios, buying backdated puts, these all kinds of different things where people are kind of setting up for this correction. Well, that's typically where the market doesn't correct, and you've got to suck all these people back off the sidelines back into the markets again to actually have the correction. This is why, we talked about before, when everybody's calling for a recession, you typically don't get a recession. As Bob Farrell once stated, when all experts agree, something else tends to happen. And that is a very, very true statement for the markets. So it always makes me nervous when everybody starts to agree with me. So, I like being the contrarian guy. I like being, kind of out there on my own. When everybody starts agreeing with me, that bothers me, because typically that's when things, kind of the forecasts don't work out. But again, I think it's worth, being a little bit more cautious here. Maintaining your exposure, but, taking profits, rebalancing risk, doing kind of your normal portfolio management stuff. Just because, the markets are extremely overbought. They are very complacent. I posted a chart on X, just over the weekend, just talking a little bit about, kind of volatility in general. And, we're just seeing, points where, you've got very, very high levels of complacency. This is, and I mentioned this earlier in the show today, but here's a chart of the amount of time that we've gone without a 1% correction. And we haven't had a 1% correction since late June. And this is just, and again, we've gone longer stretches historically, sure, but we're starting to get up there to where you've had a very long advance with, this kind of very compressed price action where markets aren't moving, up or down 1% in a given day. And, today looks like to be another one of those days. So again, these are just kind of those indicators that are at least, kind of worth analyzing. And again, when you start looking at markets in general, that kind of volatility suppression is kind of a warning sign in and of itself. And then, also, this market hasn't been, and this has also been, kind of the interesting dynamic of the market as of late. It's not just the big tech 7 that are driving the markets. It's been a much broader rally. The number of stocks trading above their 15 200-day moving averages are broadening, and you're seeing a lot of speculation in companies kind of outside the S&P. The Palantirs of the world, the GE Vernovas, the Oklos. They've had huge retail participation. We've seen a lot of, and just last week, we saw lots of speculative price action in stocks like Kohl's, and kind of the repeat of the speculative meme stocks. Abercrombie and Fitch, after Sydney Sweeney did her kind of not Abercrombie and Fitch, American Eagle. Sorry, American Eagle had a huge surge after Sydney Sweeney's photographs. So we're seeing a lot of that real speculative type activity in the markets, and that's very indicative of a overly bullish market and where risk comes into play. So again, it's worth managing, but it doesn't mean it has to happen. This thing can grind higher here for a while, and there's plenty of evidence right now the market wants to do that. We still have this, hedge funds in general, big professional investors. They've been kind of fighting this rally to a large degree. And importantly, this week, we've got end of the month rebalancing. So we've got, this kind of end of the month action coming up. When we get to the end of the month here, portfolio managers are going to want to make sure that we've got, their positions are in place for starting August as we kind of continue to move through this quarter. And depending on earnings this week from the big boys, that could really set up some moves in this market. I mean, we could see this market move 1 or 2%, over a couple of days if, the Microsofts, Amazons, Metas of the world have really good earnings, because those stocks alone make up such a big percentage of the index. Those stocks alone could pull the whole index up higher this week. So again, just a lot of things to pay attention to. We'll come back though. We'll get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Will Social Security be there for you when you're ready to retire? Richard Rosso and Jonathan Penn host our next Candid Coffee on Savvy Social Security Planning, Saturday, August 23rd. When should you apply for Social Security? And how much should you expect to receive? Register today for Savvy Social Security Planning, Saturday, August 23rd. Candid Coffee with Rosso and Penn at realinvestmentadvice.com. realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
This is Lance Roberts with some exciting news. If you've been tuning into us every morning right here on KSEV, starting August the 4th, we'll be exclusively digital on YouTube. So make sure that you like and subscribe our channel at YouTube. It's The Real Investment Show on YouTube, also streaming live on X. Just search The Real Investment Show on YouTube and hit subscribe. Starting August the 4th, we'll be exclusively digital. Get daily market insights, interviews, financial truth, anytime, anywhere. We'll see you there.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So a couple of questions in chat. Michael says 10 to 20 stocks have done all the lifting. That's not actually the case, Michael. We've seen periods in the recent past where the top 10 stocks really were doing most of the lifting of the markets. But breadth has really broadened out here over the course of the last, kind of couple of months, particularly coming off that April low we saw. It really wasn't the top 10 stocks that were pulling the markets higher. It was kind of everything else in the market. In fact, industrials, transportation stocks, those are, and technology in general, those are the most overbought sectors of the markets. And, basic materials were doing a great job of leading the way. And if you take a look, this is a chart of the S&P that's overlaid with the number of stocks above the 50-day moving average, number of stocks above the 200-day moving average. That breadth has been improving very markedly. So this has been a much broader rally. And again, we're not at, excessively high levels, kind of in the markets right now, like we saw in 2021, where you had, just kind of every stock going up at one time. But, you're certainly seeing a much broader improvement in the markets, coming off this recent low. So you're seeing more breadth in the market, and that's bullish. More participation is good. Strong markets are broad, weak markets are narrow. So again, that's certainly something to consider. And again, as we've kind of shown you before, in terms of different measures, the markets the market has rotated a good bit as of late, and we're starting to see areas of the markets that are performing well, and that in other areas of the market that haven't been performing as well. And I'm trying to log into my chart here, so just give me 1 second. We've seen kind of this rotation. Healthcare has been under a lot of pressure, and that is a fairly big component of the S&P in terms of its weighting in the overall S&P. But other areas of the markets have been doing, very well. And in fact, if we take a look at kind of the performance analysis of the markets, and we've shown you this before on SimpleVisor, this is just looking at the broad sectors of the market as a whole. And what you'll notice is that a lot of these stocks, you can go bring the chart up, Brent, for me. A lot of these stocks are up in this kind of overbought, return on an absolute. I need the chart on the right hand side as well. They're kind of this upper right quadrant where they're overbought on both a relative and an absolute basis to the market. So they're just we're starting to kind of crowd the market all in this upper right hand side. And that doesn't, that's not a bad thing. That's what you would expect during a bullish market, but it also suggests that the market advance is a lot more broad than speaking. But you'll also notice in the left, these two columns on the left, on a relative and absolute basis. On a relative basis, it's industrials, technology, transportation, materials, and financials that are really kind of overbought right now. Energy, staples, communication services, and real estate are the most oversold, but they're still have been doing well. And if we sort this by an absolute score, you even see it a little bit more. The S&P is very overbought in general on an absolute basis. Industrials, utilities, financials, materials. See, it's not just technology kind of driving the way. It's not just the big cap names. The point is this market rally has been a lot more broad in general, and that's good. Again, broad markets are more healthy, but this is also the reason this is the case is we're seeing a lot of speculation in areas of the markets like the Oklos of the world, like the GE Vernovas, like the Kamikos of the world. We're seeing a lot of speculation in those stocks because of themes. This AI, power generation, nuclear plants, those type of things. Those thematic type views are kind of driving the market. So just something to consider. Another question I had here was, what if you're sitting in a lot of cash right now? So what's your advice for having a big part of your portfolio in cash at the moment and you're waiting for a pullback? Two ways to approach that is there's nothing out there that suggests this market's going to have a major correction. I've heard a few, conversations on, various YouTube channels, et cetera, as of late. It's like, oh, the big crash is coming, right? It's the, Red Fox, Elizabeth, big one's coming. This is the big one, Elizabeth. We don't have anything set up for that right now. So two ways to kind of work this market is, look, this market is very overbought right now, but there's areas of the market that are not overbought. Again, as we talked about earlier, healthcare has been underperforming this year. And, if we go back to just kind of looking at these areas, real estate has been underperforming because of where of interest rates are. Staples have been underperforming because they're kind of defensive in nature and they're not the Oklos and the speculative names of the markets, right? So companies like, and if we kind of dig into Staples as an example, we kind of can look at those companies as well in the same manner we were just talking about a second ago and looking at just where they're positioned in the markets. And you look at a company like Costco, which is an exceedingly strong company fundamentally. Colgate Palmolive, I'll spit that out. Dr. Pepper, Philip Morris, Coca-Cola. These stocks are relatively oversold to the overall markets and to their sectors themselves. And so there's pockets of opportunity that if you think a correction is coming, money doesn't leave the market during a correction. Not everything goes down during a corrective action in the markets. Where is money likely going to rotate to? And that's when you start looking at things that are exceedingly overbought versus those areas that are not overbought and potentially even oversold. And again, healthcare and staples, those type of companies have had pretty lagging performance this year, but those are more defensive in nature. So I would look to start accumulating some positions. If I have a lot of cash right now and I need to build a portfolio, start looking to build some positions in more defensive areas of the markets. And then once you do get the correction, which the correction will come in those higher flyers, right? So the technology sector will take potentially the biggest hit during a correction, and particularly not, the Microsofts or the Amazons, because they've kind of lagged this market rally to a large degree. it'll be the more speculative names in the index. So for instance, we have a correction. You could see the Oklo's down, 10, 15, 20% pretty easy. The Palantir's down 10, 15% pretty easily. GE Vernova's down, 10, 15% pretty easily. But you'll see money rotate into some of these defensive sectors. And then when those things correct, you can then add those to your portfolio at much better prices. So again, it's not being all in or all out of the markets. It's just kind of selecting your spots and looking for, areas of weakness that potentially will catch rotational flows when you have a correction in the markets. And so this is, again, none of these are recommendations, by the way. I'm not making any financial advice or recommendations. I'm not telling you what to buy, just my CYA for SEC compliance. Just kind of giving you some examples of things to look for. So yeah, if you've got a lot of cash, there's a couple of ways to work through this. One, if you're an ETF investor, just start nibbling, right? You're going to buy some stuff high here, but break your cash up into 12 pieces and buy one, put 1/12 of it to work over the next 12 months. And that way you'll kind of work through the decline and get your portfolio built. If you're an individual stock selector or even in ETFs, look for those ETFs that are more defensive in nature. Start building that portion of your portfolio now to build a balanced portfolio structure when you come out of this. But as we work through this kind of corrective cycle, pick up your defensive now when they're oversold, and then when kind of the growth momentum sector takes a hit, you can add to those stocks as well coming out on the other side, and eventually come out of this on the other side with a more well-balanced portfolio. And then the one thing to do going forward is stop getting large chunks of cash in your portfolio, unless you're, just accumulating a lot of cash. But stop swinging your portfolio into big cash positions, because the challenge is always, the problem is like you'll hear somebody on YouTube say, oh, the market's going to crash, you better be in cash. So you move everything into cash or a big chunk into cash, and then the market keeps going up and you can't figure out how to get back in. That's always the problem. And this is why we always talk about small moves. Manage your portfolio in small moves. Take profits, rebalance risk, do some sector rotation within your portfolio. But don't move big chunks in and out of the markets, because that's where you're really going to start to pick up on underperformance, start making all those mistakes in your portfolio from a psychological basis, start impairing your ability to get performance over time, which is what you need your money to do. It's, markets are not an all or none game. Like we talked about before, it's a lot like football. It's just, I just got to move the ball down the field and just avoid the fumbles as much as possible. Doesn't mean you're not going to fumble the ball every now and then. And, in a football game, you have turnovers all the time. You have fumbles, you've got interceptions, and you can still win the game, even if you make errors. And so making errors are okay. What you don't want to make is an error that loses the game for you. And so trying to focus on just moving the ball at inches and just moving down that field towards your ultimate goal, and just managing the risk of your portfolio along the way will certainly pay off, as you get there. So just, something to help you out here. So anyway, we appreciate it very much. Be sure to like and subscribe to this channel, as next week, coming up on August the 4th, we'll only be streaming live to YouTube, X, LinkedIn. Where else? Not LinkedIn yet. Meta, Facebook. We'll be streaming live there. So show will be moving to all digital starting August the 4th. So make sure you subscribe to our YouTube channel. Make sure and follow us on our website, realinvestmentadvice.com. Follow me on X. Follow me on Substack at Lance Roberts on both of those to get all of our articles, our daily market commentaries. All of our videos are there as well. So again, plenty of places to find us. You're not going to miss us. Easy to get there. But it's all at realinvestmentadvice.com. See you back here tomorrow.